Canadian bank stocks have hit a fresh all-time high. We've got one of the biggest bears on the sector joining us now. Nigel D'Souza is financial services analyst at Veritas Investment. Thanks so much for being with us.
Thanks for having me.
So you only have one buy rating on the Canadian banks, and really since 2017 you have shifted from a couple of sell ratings to eventually sell ratings on all the Canadian banks. And here we are with the bank stocks at all-time highs. How do we reconcile this call?
So I think the important part to really consider is what happens on a go-forward basis, right? So the call that we had wasn't a 3-month or 6-month call. It was a call that was centered on the credit cycle and the expectations for when credit losses would peak in the sector. So our view currently is that, and has been, that credit losses are going to peak for the sector towards the end of 2020, early 2021. So we're about a year away from that. And if you look back historically, banks typically start to sell off a year before credit losses peak, and they bottom when credit losses peak. So we think there'll be a buying opportunity a year from now. But if you own bank shares right now, I think now is a good time to either change your exposure, maybe reduce it, or consider specific bank risks because the banks trade less like a group and more heterogeneously during a credit cycle.
So let's talk about that thesis of seeing peak credit losses starting next year and bleeding into the year after. What's going to drive that in an environment where we've got low interest rates, and if these trade headlines hold, which I guess is a big wild card, you could start to see economic growth start to pick up?
So that's a good factor in terms of thinking about the backdrop. But here's an interesting counterpoint in that despite having a relatively strong economy, GDP is still growing, unemployment is relatively low, and we have interest rates that have been declining this year. Despite all those positive economic forces, the Canadian household debt service ratio, which is the amount that Canadians put towards principal and interest payments, hit a record high recently in the second quarter of 2019. So the previous record high was during the financial crisis. It was about 14.7%. Now we're a little above 14.8%. So we had to have a financial crisis to get to 14.7. And with a relatively stable economic, even you could say positive economic backdrop, we're already at a record high.
Wonder if you could just give me a concise answer to this question. Do you think we could see a hot economy for Canada, like a pretty strong economy going ahead?
So there's a bit of a catch-22 here, right? If there is a strong economy, then the yield environment is going to shift, and we're going to have yields move higher.
Right.
And if yields
so do you expect that?
Right now, I don't think the data supports a significant economic strength. The outlook is definitely more positive now than it was 3 months ago. Okay. But that's also reflected in government bond yields being higher now than they were a month ago.
The reason I'm asking that is Patrick Horn, who's a regular guest on the program, came on yesterday, and he loves U.S. banks. He's not as excited about Canadian banks, but he said his own personal only bearish case is if the Canadian economy is so hot that we're getting back to a conversation around raising interest rates, which is kind of where the conversation was around North America at the start of 2019.
Yeah, so the dynamic between interest rates and expectations and the ability and sensitivity to interest rates is a big component. The point being, like right now we're at a point where the economy is stable, but the household sector is highly vulnerable, right? So savings rates are at a cycle low. So if you back out pension contributions, they're actually negative. Debt to income is at a cycle high. And debt servicing ratios, the amount going towards paying debt, is also at a cycle high. And you have to keep in mind that we have vintages of mortgages, 2015, 2016 vintages of mortgages that are up for renewal in the next 12 months that were originated at rates that were far lower than current prevailing mortgage rates. So you have this huge reset also occur in the next 12 months that I think could reaccelerate debt servicing costs.
One of the things that might be beneficial to those people is housing has caught a 9th life, 10th life. It's come back. You've started to see these home prices, home sales activity start to perk up. To what extent might that blunt your thesis?
So that's an interesting point, because when you look at the yield environment and the declining interest rate environment, one of the primary beneficiaries of that has been a reacceleration in mortgage growth. So mortgage growth, particularly in the regulated bank space, has reaccelerated recently. Now that's a positive for the real estate market. Sales are up, prices are up, but debt's also high for the household, right? So Canadians didn't take advantage of lower interest rates to deleverage. They've actually increased their leverage. So that is positive for the real estate market. And the real estate market should remain stable unless we enter a recession. And the most susceptible segment of the real estate market during a recession are investors and speculators that are negative free cash flow. So these are individuals where the rent doesn't cover the mortgage plus other direct property costs. They probably can't sustain a negative carry asset in a recessionary environment. And you don't get a price correction without a supply shock. And the supply shock, I think, can only come from those investors.
So much of your thesis seems to be built on what's happening in Canada, yet you have a sell rating not just on CIBC, but also TD, which has big exposure south of the border. I imagine the thesis is a little bit different for TD versus a CIBC or any other more nationally exposed bank.
It is different in terms of you have to consider whether their international business segments are going to offset the domestic slowdown. But TD's U.S. retail segment hasn't really offset the credit losses we've seen in Canada. In fact, the PCL ratio for TD is relatively higher than the sector, and part of that is because of their exposure in the U.S., specifically the U.S. consumers. And U.S. auto finance is a major part of the credit market, and that's typically a segment where you see cracks forming first. So, for example, in U.S. auto subprime, the subprime delinquency rates are the highest they've been ever. They're even higher than what they were during the financial crisis.
So I just want to go back to that board we just showed before, which has the target prices, for your target prices, which I find more helpful than buys or sells. That would suggest double-digit declines for names like, in percentage terms, for names like TD and Royal. The rest of the Bay Street analysts see those names kind of 12-month out, flat to positive. What do you think is the one difference between the rest of the Street's call and your call?
I think the main difference is the outlook on the credit cycle. Like if your outlook is for gradual normalization of credit, so maybe 10% year-over-year increase this year and next year, then that's really a normal operating environment. That isn't a credit cycle. So my expectation is for credit losses to pick up materially, and that I think is the main difference driving my expectation for the sector versus the Street view for the sector. It hinges entirely on the credit risk to the space.
Nigel, thank you so much for joining us with your updated insights.
Thanks for having me.
That's Nigel D'Souza, Financial Services Investment Analyst at Veritas.